Hello, my name is Andrew Lake and I'm going to be talking to you about the fixed income markets today. Firstly, it's been an incredible 3 months since the Fed first stepped in to support the markets back in the end of March. We've seen a huge rally both in equities and fixed income, but I want to touch upon fixed income today and discuss the technicals behind both investment grade and high yield in the US and in Europe. Clearly, the Federal Reserve has pinpointed various areas of fixed income as its priority in terms of support, and these have been up to 5-year investment grade and certain parts of the high yield market, including fallen angels. This has seen huge rally in these particular areas, and we continue to see huge technical strength behind them. As we move into what looks like a V-shaped financial recovery, the question remains whether this is a V-shaped economic recovery as well. We clearly have very little inflationary pressures at the moment. We have interest rates close to zero. We have potential yield controls coming in, which the market is continuing to discuss. And we have a Federal Reserve and other central banks around the world that have fully committed to supporting the market and the economy until we see things recover. From an asset allocation perspective, we continue to think that the US provides very strong technical tailwinds over and above Europe. We still see spread returns, spread compression as one potential aspect to the fixed income market. We continue to see that there may well be economic volatility along the way. I focus particularly on employment and how quickly that will or will not recover. That will have a direct effect on discretionary consumer spending and thus a normalization of economic returns. A V, a U, a T, a W, all these things have been mentioned in terms of how the recovery might look, but clearly I think a V at this point is unlikely. We continue to see defaults and distressed companies in our universe, particularly around the high yield market. This will continue, and we will continue to see credit concerns around these smaller companies with less ability to survive this crisis. There may well be a correction at some point in the future, but as I've said, the stimulatory measures of the central bank continue to be very strong, and the market is overlooking the short-term pain towards the long-term normalization of markets, and that is why we've seen this rotation from less cyclical companies into more cyclical companies, particularly around travel, consumer businesses, airlines, those areas most at risk to the economic downturn.